All right. Thank you, Sam. And thank you, everyone, for joining us today for the 2022 year-end tax planning webinar. We have a very interesting mix of topics to cover, really from kind of all over the tax landscape, including some of our specialty groups. And in addition to that, we have a couple other areas maybe outside of what you think of traditionally tax that are certainly worth knowing about if you are a business owner. So bringing you these topics today, if we can move on to the panel list. And joining me is Grace Koskinen, who heads up our EV-related energy credit initiatives. Lisa Pohl, our Director of State and Local Tax. Alex August is joining us from the international team. Mike Powell, our practice lead for R&D credits. And Gerald Wernette, who is our Director of Retirement Plan and Consulting. And my name is Tony Cavoli. I am a part of our tax consulting group and will be helping to moderate today. So let's actually just move on right into the Inflation Reduction Act. It's a relatively new law. It was signed back in middle to late August of this year, of 2022. And it really was so if you're on last year's year-end planning, it really was a pared down version of the Democrats' Build Back Better Act, the BBBA. And if you recall, that's the bill the House had passed back in 2021, and it ran into issues in the Senate, specifically with Senator Joe Manchin. He would not vote for the bill due to the cost estimate, and that was somewhere between 2.5 to 4.5 trillion for the Build Back Better Act, really depending on who you asked at the time. So fast forward to the Inflation Reduction Act, and this was really a compromise within the Democratic Party that resulted in significantly less tax changes within the bill. So let's talk about on the slide here kind of what is actually included in the IRA from the tax side. So number one on there, there's a 15% corporate minimum book tax, basically an alternative minimum tax on a new term, adjusted financial statement income. But the key here is that this really only applies to corporations that have over $1 billion in income. So we're really talking about some of the world's largest publicly traded corporations. Next item on that slide, sort of similar. It's an excise tax on stock buybacks, but again, the similar part that this is only going to apply to or limited to publicly traded companies. All right, so we'll skip over the next one. We'll move down to the IRS funding. So there's an additional $80 billion of increase in funding for the IRS. And I think the interesting thing about this is that 45 billion of that 80 billion is going to be used for IRS enforcement. So we certainly expect a increase in the number of audits, probably starting, 3 years from now, maybe going on for the next 10 years. They need some time to obviously hire and train auditors at the IRS. And our last item in the IRA included quite a lot of enhancements and extensions of already existing energy credits. And we're not going to cover them all, but I'm actually going to turn it over to Grace right now, who's going to talk specifically about a few of those enhancements really related to the EV side or the electric vehicle side. So Grace?
Thanks, Tony. Like Tony said, my name is Grace Koskinen. I'm a tax manager in the Troy office. I'm going to be talking about the energy credits that were either added or expanded by the IRA. So I'm going to first start with electric vehicle credits. The clean vehicle credit was in place before the IRA, but the IRA implemented several changes that will phase in over time. So for vehicles placed in service before most of these changes take place, so from August 17th through December 31st, the original law applies with one added provision, which is the vehicle must have had final assembly in North America. This provision of the law carries forward after 2022 as well. The credit starts at $2,500 and it's increased $417 per each kilowatt hour over 5 kilowatt hours, with the max being 7,500. So that's before 2023. So placed in service after December 31st, this is where we start to see the bulk of the changes come into play. The credit is simplified in that although the max credit is still 7,500, it's divided into two subparts. So 3,750 is received if the critical mineral requirement is met, and the other $37.50 if the battery component requirement is met. There's also restrictions as to the weight of the vehicle. So it can't exceed 14,000 pounds for this credit, and the MSRP can't exceed $80,000 for vans, SUVs, and pickups, or $55,000 for any other vehicle types. The credit counts as a general business credit to the extent it's attributable to businesses. Otherwise, it's a non-refundable personal credit, which is limited to adjusted gross income and cannot be carried forward. So continuing on, with electric vehicle credits, I'm going to go into some brand new provisions from the IRA. The first is the previously owned vehicle credit. This is for individuals only. The credit's the lesser of 30% of the purchase price, or $4,000. Similar to the clean vehicle credit, it's a non-refundable credit. It applies to vehicles placed in service after December 31st. And the vehicle has to be at least 2 years old with the sales price not exceeding $25,000 and the weight can't exceed 14,000 pounds. The other credit, the commercial clean vehicle credit, also brand new. It's geared more toward businesses with heavier machinery and vehicles. So vehicles placed in service after December 31st, the credit's the lesser of 15% of the cost, 50% if not powered by gas or diesel, or the incremental cost of the vehicle, which is the excess of the purchase price over a comparable vehicle, which we're still awaiting guidance on to what exactly that all means. The maximum credit per vehicle under 14,000 pounds is $7,500, while heavier vehicles have a limit of $40,000. Again, general business credit. Vehicle itself must be primarily used on public roads, but can also be mobile machinery. So, farming equipment, construction equipment counts for that. And it has to be significantly propelled by an electric motor or fuel cell motor. And then the last credit I'm going to talk about today is the alternative fuel vehicle refueling property credit, which is a fancy word for a charging station credit. This is another credit placed in service before the IRA, but it was just expanded upon. For property placed in service before December 31st, it follows the original law completely. Credits the lesser of 30% of the cost of the station, or $30,000. For non-depreciable residential property, so you have a charging station at your home, the credit's the lesser of 30% of the cost, or $1,000. It's calculated with respect to all property at a single location, but this changes after December 31st. So in 2023, the credit is calculated with respect to any single item of property, which makes it a lot more advantageous. The credit also increases to the lesser of 30% of the cost of the station, or $100,000. Residential limits, though, still apply. On top of this, though, the property must be located in an eligible census tract, which is either a low-income community, meets certain poverty rates, or is not urban. This part's vague, but we're supposed to look at the latest census to figure out what urban versus rural is. But unfortunately, that won't be finalized until, December or January area. And then one more major caveat with the 2023 property is the 30% limit goes down to 6% if certain wage and apprenticeship requirements are not met. The IRS released some guidance about that in late November as to what these requirements are, but they were not very specific. But this particular portion of the law goes into effect 60 days after that guidance, or January 29th. So just be wary of that. I think that's really about it for this, but please note there are more energy provisions that were implemented under the IRA and a lot more limitations imposed by the laws I was just talking about. So if there's any questions at all the particular situations, please don't hesitate to reach out. Back to you, Tony.
All right. Thank you, Grace. Definitely a lot of going on, not just on the energy credit side, but definitely within the EV side itself. So, I just read yesterday that Ford, maybe 2/3 of the Ford dealerships opted into selling EVs. I know that requires significant investment on the dealership end. So, these tax incentives, whether you agree with them or not, they're certainly going to be utilized as a selling point going forward. All right, so next we're going to move on to our tax specialty groups to talk a little bit about what to consider on the state and local and the international side. So Lisa, let's start with you on the SALT side.
Thank you, Tony. I'm going to start off with what has been a very exciting area for state and local, and that's the pass-through entity level taxes. And I'm starting with one of my favorite, a map that shows which states are offering it. And I'm going to follow that up with some of the detail about what are pass-through entity level taxes. But I wanted to show the audience from this map that there's 29 states that offer it, and one local, and that's New York City, that are offering this, just to show how much activity has been happening in the last couple of years around these pass-through entity level taxes. And when you take a look at how many states don't have an owner level tax or a personal income tax, it's really becoming, it seems like almost every state is offering a pass-through entity level tax. And if we can go to the next slide, I'll get into what is actually a pass-through entity tax. Well, we have to start off with, we need to have a pass-through entity. So this is a tax that is for our entities that are not a C Corp. So they have to be a partnership or an S Corp. It's generally not available for a disregarded entity. So it needs to truly be an entity. And they were designed to avoid the $10,000 SALT cap at the individual level. So states were trying to find a way to help the individual taxpayers around that. And what the taxes do is they convert an individual income tax that are paid via a non-resident withholding or a composite tax into an entity level tax. So they're taking that tax burden and they're shifting it from the individual to the entity, and it allows the entity a full deduction from taxable income on the Schedule E. So it reduces our starting point, our federal taxable income for our flow-through entities. And the IRS had said through a notice that they would allow that deduction and that they would honor it, and that there would be forthcoming some additional guidance. There has not been any additional guidance. So this seemed like a win for individuals. It seemed like a workaround, and I was a little surprised at how quickly states were jumping on this. But again, if you go, we're not going to go back to our map, but it is a nice thing if you have an entity that's in multiple states to look at it and say, hey, where might this be available? But I want to point out that it's the structure of how the tax works varies from state to state. Generally, the tax works by the owners claiming a credit against their personal income tax liability, or it works as an exclusion to the amount of income that's flowing through to the individual. The timing of the elections vary from state to state. The relief from non-resident withholding varies from state to state, and the relief from filing an individual income tax return varies from state to state. So the reason I point that out is there seems to be a kind of a misconception that these pass-through entity level taxes convert the entity to a C Corp. And that automatically that means that if an entity is filing a pass-through entity tax, that there's automatically no non-resident withholding, automatically no individual income tax return due, automatically no composite return, income tax return due, because it's at the entity level. Well, it's not turning the entity level tax into a C Corp tax. So just keep that in mind. If you make the election, it doesn't mean all the other liabilities or filing responsibilities for income tax go away. So for instance, in California, they offer a pass-through entity election. It does not relieve your non-resident withholding. It does not relieve an individual filing. And for any members who take advantage of the pass-through entity election, those individuals cannot be on a composite return and they have to file a non-resident return. So that's dramatically different than some other states. So just keep in mind that it's not as simple as just making the election. And if we can go to the next slide, also some other considerations besides how it works for each state. These aren't always just a natural, yes, a win, we should always do this. Some considerations and some planning should be looked at is, this does reduce the federal taxable income for the entity. So that could have an impact on some of the federal credits. Also, if you have if the entity has corporate owners, you have to see what happens. It varies from state to state. What happens for the corporate owners? For some of the states, it's that portion might be removed from the tax. For others, that credit's just simply lost. A big consideration is the ability for the owners to utilize the credit for taxes paid to other states in their state of residency. So there's several states that will say, if the tax is paid at the entity level in their home state, they don't get a credit for taxes paid to other states like they would have if it had been paid on a composite return. Therefore, you could end up in a situation where individuals are almost being double taxed, which results in a higher overall individual income tax. So it's not always a win to make these elections. And then cost of any additional compliance. A really easy example for that is Michigan. In Michigan, pass-through entities, if they don't make this election, there is no return to file. If they do make this election, it's a binding 3-year election, and they now have to file a return. So in some other states, it simplifies the compliance, or it's a different return, and maybe it's more complex than the return had they not made the election. So there's a lot of moving parts. It's a great answer. It's something that should be looked at, but don't just assume that because you're going to get a chance to step around, work around that $10,000 limitation, that it's an automatic yes. So think through that. And if we can move on, the other areas that have been exciting in state and local tax, there were a lot, so I had to narrow it down because I only had a few minutes, but something that has been getting a lot of attention, last couple of years, it's been all about sales tax with Wayfair and Economic Nexus. Well, in the last year, there's been a lot of focus also on physical presence and our remote workers. So just here, I wanted to remind everybody, what is our Nexus? So it's just Nexus is what is our connection with the state? It's a fancy word for connection. And that connection is what allows a state to subject us to tax. And on the next slide, what does Nexus allow a state to tax us for? There's our list of our taxes. So something that we keep running into, and something that didn't happen again this year, is our remote workers. And when I say what didn't happen again this year, is every year businesses ask Congress, please do something that would limit a state's ability to impose income tax and sales tax for our remote workers. I think for at least the last dozen years before Congress has been a bill that says, could you please, put a limit, kind of like Public Law 86-272, that would limit the state's ability. If I have just a remote worker that's designing websites, or a back office worker that would say you cannot impose an income tax on us, that did not get passed. It didn't get any traction again this year. So we're still under the rules that have always been there, that if you have a worker who's in another state, they're going to create Nexus. And these are the types of taxes that you'll be subject to. And if we can go to the next slide. And this is just a reminder that sometimes there's a limitation that a state might offer for a threshold for withholding, but most states are going to say if you've got as little as one person in a state, that's going to be enough. And with remote workers and the ability for everyone to be working remote, it's just something that I want everyone to keep in mind as we're moving forward, that states are really ramping up their due diligence around this. And on the next slide, I want to contrast that with something that has been always a part of a Nexus review, or the thoughts of Nexus, is if you have inventory in any state, you automatically would have Nexus. Well, case out of Pennsylvania in September came out and said that if you have inventory for an Amazon fulfillment center, you do not have Nexus, because the taxpayer did not get to choose where Amazon stored and shipped that inventory. So in essence, the taxpayer didn't have any control. They were not establishing and maintaining their marketplace. It was actually Amazon that was. So that was a bit of a shock, I think, in the tax world, because the states have always been, and everything has been driving towards, a strict interpretation of, if you've got physical presence, this is how it is. And this harkens back to really the constitutional interpretation of it. So that was a big contrast to it. But another contrast with it is the multi-state tax compact revised their interpretation of Public Law 86-272, which limits how much when a state can impose an income tax if you're only soliciting the sales of tangible personal property. Say if you've got a salesperson and all they're doing is soliciting the sales of tangible personal property, well, they've narrowed that to say if you're soliciting the sales of tangible personal property and you're not in the state, but you have an interactive website and you're taking orders, that you no longer have that exceeds Public Law 86-272. So all of that discussion of Nexus is just to let you know it's still in flux. We still have to worry about it. If you have activity and you have sales in a state, it's still something that you should be focused on and looking at when trying to determine your overall state and local tax impact. Thank you, Tony.
All right, thanks, Lisa. Yeah, very, very interesting to see that inventory ruling, and just on the SALT workarounds, how many states have implemented it, and really how passive the IRS has been with these types of workarounds. So up next, we have Alex August, who's going to let us know what's going on from an international standpoint. So Alex.
Well, thank you, Tony. Hello, everyone. My name is Alex August. I'm an international tax principal at Raymond, and I'm going to be discussing the latest developments in a couple of ever-changing international tax topics. Those today being the Forms K2, K3, and the foreign tax credit regulations. As a refresher, the Forms K2, K3 are a supplement to Form K1, and they report the distributive share of international items to partners and S corporation shareholders. This became a new requirement on the 2021 tax returns. If any of you were familiar with those forms, they were quite a heavy lift for taxpayers and tax return preparers last year. And of course, they're coming back around this year and will continue long into the future. Regarding 2022 tax returns, the IRS recently released draft instructions in October describing some updates to the form filings. And then just last week, issued revised instructions on December 2nd to those 2022 forms. And the most significant of those changes relates to what we're going to talk about here shortly, this domestic filing exception. But I just want to make everyone aware that we're still working with draft instructions and draft forms, so additional changes are still possible. So please stay tuned. Regarding the foreign tax credit regulations, the IRS recently released proposed regulations related to the foreign tax credit. Now, the foreign tax credit regulations have been in the works for several years now, post TCJA. The first proposed tax regulations were issued in 2019. After that, correcting amendments were issued to those 2019 regulations. And then finally in 2020, final tax regulations were issued, shortly followed by new proposed regulations, followed by corrected amendments to those proposed regulations, followed by the 2022 final tax credit regulations, now finally resulting in these new proposed foreign tax credit regulations issued just about a few weeks ago in November. So this is an ever-changing area. The IRS issues guidance, taxpayers, practitioners take exception to some of the guidance, IRS modifies the guidance. It's this back and forth dance that's been going on for several years now. But we do have final regulations that are in play, but we also have proposed regulations that are currently in play. So we're going to be discussing a few of those key issues related to these regulations here shortly. Regarding the K2, K3, just some background information. So any partnership or S corp with items that are relevant to the determination of U.S. tax or certain withholding taxes or reporting obligations of its partners under the international provisions of the Internal Revenue Code are required to file these forms. So with that, in a practical matter, what that means, if your flow-through entity is providing information to its shareholders and partners that will affect a foreign tax credit calculation, then the K2 or K3 form must be included. It also is applicable to certain foreign partnerships, certain owners of foreign partnerships, foreign persons owning partnership interests have to file this form as well. And this whole thing, the centerpiece is this concept of international relevance. It's a broadly defined concept that means any item of information that comes from your flow-through entity return that could potentially affect the determination of a foreign tax credit or any other international item on a taxpayer's return needs to be included on the K2, K3. So it even could come into play in the case of an entirely domestic partnership or S Corp that has no foreign source activity whatsoever, because the information from that K1 could potentially affect the calculation or allocation of expenses on a foreign tax credit. So it's a very, very far-reaching concept. But fortunately, there are some exceptions to the need to file these forms. And one of the big exceptions is this the domestic filing exception. That was an exception that was actually in place in 21. The IRS provided transitional relief with respect to entirely domestic entities. And it was expected that transitional relief was going to go away and would no longer be available going forward. But fortunately, the IRS has continued to provide relief to domestic partnerships. And they've actually slightly expanded it a bit, but also added a few additional requirements. So to the extent that you're a domestic filing, to the extent the domestic filing exception applies for 2022, these conditions all have to be in play. There can't be any foreign activity with respect to the partnership or S corporation, with exception to a very, very de minimis amount of income. $300 of foreign tax credits cannot be exceeded. All the partners have to be, or S corp shareholders have to be U.S. citizens, resident aliens. So essentially, they all need to be U.S. persons. They can't be a foreign person. If a foreign person is involved, the K3 form must be filed. This is a new development this year for 2022. Partnership notification. A partner that meets the first criteria must notify the partners that they will not receive a K2, K3 unless requested of them. So this notification must be provided to at the latest when the partnership files its K1 to the partner. So essentially, what's going to happen here in this new 2022 development, a partnership or S corp shareholder can provide notification to its partners and shareholders upon issuing the K1, which I think is a practical matter what's going to happen. And then at that point, the partner receives that notification, and they can subsequently request that they have a K1 issued under point 4. But generally, it will relieve the partnership of the obligation to issue the form if the partner hasn't previously requested that the K3 form be issued to them. But in order to do that, they have to satisfy point 4 here within 1 month prior to the partnership return being filed or due. They have to tell the partnership that they need this information, this K3 information necessary to file their individual income tax returns. So notification is going to be a new item that we're dealing with this year. With regard to foreign tax credits, as I mentioned, there's obviously ongoing regulations and proposed regulations, which is kind of level set the field here. In general, what is a foreign tax credit? I think most of us are familiar, but a foreign tax credit is intended to reduce the double tax burden that would otherwise arise when a foreign source income is taxed by the United States and a foreign country. So to the extent that foreign income is included on a U.S. return on which foreign tax is paid, a U.S. taxpayer can generally claim a foreign tax credit. In order to qualify, the tax must be a legal foreign tax liability. It has to be established under foreign law. It must be legally imposed on the person who's claiming the credit. It must have been paid or accrued, and it must be an income tax. or in lieu of an income tax, meaning it acts in a similar fashion to United States income tax law. Next slide, please. Now, there are a few very key issues that have evolved with regard to these regulations, and I identified 4 of them here that I think are worth discussing. But I think before we get into those, we need to take a step back to kind of understand what's going on here. There's an overriding concept that underpins all of these issues. And the IRS is imposing limitations on foreign tax credits when countries have tax systems that are not substantially similar to the US. So the United States or the IRS has taken the position that if your system isn't functioning in a similar fashion to the US system, you may be denied a foreign tax credit. Now, taxpayers, when they've seen these regulations and proposed regulations, have been very upset about them because in a lot of cases they're denying tax credits that have been available and existed in the past. And we'll start off with the first item here is our attribution requirement, which is new under the regulations. And this has to do with sufficient nexus. Now, nexus is typically a concept that Lisa is much more familiar with than we are in the tax world. It's much more of a state and local concept, but it does kind of appear here in the proposed regulations. And what this indicates is that in order for a tax to be creditable, the U.S. taxpayer has to have some sort of nexus or connection to the foreign country in order to establish its right to tax. And there are 3 tests that are involved in order for determining that. There's an activities test, a source test, and a situs test. But in the past, some countries, and they continue, some countries impose withholding taxes based on where the benefit is received by the resident, based on the residency of the taxpayer. So not based on where the activity is actually occurring, as opposed to US rules, which indicate that sourcing has to be considered when determining the eligibility for taxing. So for example, Brazil imposes a 15% withholding tax on payments for services provided by a US company in the United States. And they impose that tax based on the benefit being received by a Brazilian business. So that tax would not be creditable under the regulations because under US standards, there is no US activity, there is no US source. Brazil just is imposing this based on their tax law. So they're not following the US rules regarding sourcing. Next, we have the cost recovery concept. And this is going back to what constitutes an income tax. So the tax has to be based or similar to US tax standards being an income tax, meaning the tax base must be computed by reducing gross receipts to permit the recovery of significant costs and expenses attributable to those gross receipts. So for example, a tax on income. So this requirement would eliminate any gross receipts types taxes from being eligible for foreign tax credits. And the proposed regulations provide a safe harbor for determining whether the standard is met or not. So this is a key significant area that we're going to have to think about going forward. There's also there's been some controversy regarding the payment of royalties. US tax standards require that the sourcing of royalties be based on where the intellectual property is used, whereas some countries, once again, don't tax based on that basis. They may tax based on residency. And as a result, there's a disconnect between the US and foreign standard, which would potentially disallow a US foreign tax credit on such royalty payments. So there's a workaround within the regulations that indicates as long as there's an agreement in place that indicates that the IP is going to be used solely within the foreign jurisdiction, the credit will be available. So essentially converting that back to a US standard. And lastly, the allocation and apportionment of foreign income taxes has been a key issue, especially with regard to disregarded payments and reattributions. So the issue here is, what if we have a US entity that owns 2 foreign disregarded entities, and those 2 foreign disregarded entities have transactions between each other? Those transactions are entirely disregarded for US tax purposes because it's an intra-company transaction. So there were no gross receipts associated with that specific transaction. But there are underlying taxes being paid in separate foreign countries. So these regulations describe the situation for how you handle the income shifting and asset shifting for the purposes of calculating the foreign tax credit. And that's all I have on these two important topics, but stay tuned and certainly more to come.
Hey, thanks, Alex. Yeah, the K2, K3 reporting, I think, seems to change on a weekly basis in terms of who's accepted, who's not. And I thought I read earlier this morning that there's some relief coming, or if it hasn't come, on some of those notifications to partners. So stay tuned for that. So we're going to switch gears right now and move over to the federal tax side of things. And I'm actually going to turn it over to Mike to talk about some R&D updates. So Mike.
Thanks, Tony. Yeah, and hopefully this slide becomes a moot point within the next 9 days, and I'll get to that. So when it comes to research and development with respect to taxes, there's two code sections. One is Code Section 41, which defines and illustrates how to calculate a R&D tax credit. And that code section looks to Code Section 174, which defines what a research and experimentation or an R&D expense is. And to give you a little background on why we're speaking about this particular slide and what laws might be changing or might not change, back in 2017, when we had the Tax Cuts and Jobs Act, the CBO scored that legislation and said that this will create huge deficits, and I forgot what over a 5-year period is. I think it was $22 billion, and said, so we have to come up with the second bullet point here. So prior, and I'll get to that. So prior to tax years beginning in January 1st of this year, under Code Section 174, which defined what an R&D expense is, you could basically treat those expenses in two ways, or most taxpayers did. First, they would expense those R&D costs in the year they're incurred. So if you had wages of engineers associated with qualifying activities, you would deduct those wages in that year that you paid the wages. Alternatively, some companies would like to do the matching effect, in which they would amortize their research and development costs over a period of no less than 60 months. So within the Tax Cuts and Jobs Act, for any tax year starting after December 31st of 2021, they kind of remove that option of expensing those costs in the current year. So now if you have research and development tax credit or costs, again, like those wages or supply costs or any outside vendors helping you with your product development or manufacturing developments, you're required currently to amortize those costs over 60 months. And it's under a half-year convention. For those companies that utilize, let's say, overseas R&D assistance for like wages or third parties, you're required to amortize those costs over 15 years. So when I said hopefully this will change in 9 months, because if you think logically, if you're paying wages to people, engineers within your firm or your company, and you can't deduct those in the current year, it just doesn't make sense. So there's an omnibus bill that's currently in legislation, so that the government, the federal funding stops on December 16th of this year. So they need to get legislation passed before December 16th to keep the government going. So one of the things, and it's between the two different parties. One party is very intense on getting the child tax credit going to be extended, and one party wants to take this particular law, which is requiring taxpayers to amortize these costs over 60 months, off the table as well. So there's negotiations going into these two types of these credits or these expenses. And so there's a misnomer, Tony, on some of these companies. And so each manufacturing companies, regardless if they know it or not, they have some type of R&D expenses. So if you're doing new product development, or you're improving on your manufacturing processes, or you're developing new tooling or new manufacturing processes, under the Internal Revenue Code, those are R&D expenses. So there's a misnomer right now that it's like, I don't take the credit, so I'm just going to expense these costs like we're currently, or like we've done in the past, which is not the case. So it's not an if or. It's not I'll take the credit and I'll amortize these, or I won't take the credit and I will expense these current costs. So even if you haven't been taking the R&D tax credit, which is a permanent difference in your tax liabilities versus this is kind of a timing difference, you're still required to amortize these costs, but hopefully within the next 9 days that this will be overturned, and that we wasted 5 minutes maybe speaking about this, because again, it just doesn't make common sense. And not for employees to deduct their employee, or the employers to deduct their employees' wages. It just doesn't make sense. So hopefully they'll rectify this within the next 9 days. But one of the things you also spoke about, and I think Grace does too, is the Inflation Reduction Act, in which part of that act also increased the amount of credit that startup companies could use against their payroll taxes. So prior to the IRA, companies who had qualifying R&D expenses and took advantage of the credit, they could offset $250,000 of the employer's share of payroll taxes. And that it was against Social Security taxes. And you got that credit on your 941. So now with the IRA, you can also offset $250,000 of Medicare taxes. So what is a startup company? A startup company is a company that is less than 5 years of maturation, including the year that they're going to take the credit, and they have less than $5 million in gross receipts yearly. So what the benefit of this, Tony, is a lot of startup companies don't have taxable income. So why take advantage of this credit if they don't really have taxable income? So it's helping those companies offset some of their payroll taxes with this particular credit. And so that's about it with the R&D. And again, hopefully cooler heads will prevail in Washington, and our clients and taxpayers won't be required to amortize these expenses over 60 months.
Yep, thanks, Mike. Yeah, we were definitely crossing our fingers on that one, so Congress removed those capital requirements. So moving on, we're gonna move quickly through the next 3 slides. But another change I think that everyone hopes that, or at least people in specific industries hope Congress steps in to kind of prevent, that's already happened, is the interest expense limitation deductibility change. Basically, for companies that are subject to interest expense limitations, you are no longer going to be able to add back your depreciation and amortization when determining that limitation. So basically, if you are a company with a significant amount of debt that may have not been subject to the limitations in the past, going forward, and meaning 2022, you may be subject to those limitations going forward. So moving on to next slide, bonus depreciation, that's going to begin to phase out over the next several years. So planning point, to the extent you can, I know it's close to the end of the year, but you can place something in service by the end of the year, you still will be able to take advantage of that 100% write-off. And then going forward, it's going to be reduced to 20% every year until 2027, assuming that Congress doesn't act to change that. Next slide. These are some changes that are several years away. Again, you see they're December 31st, 2025, but the individual provisions in the Tax Cuts and Jobs Act back in 2017 are going to start to expire. The big ones being individual tax rates are going to go back up. The QBI, or the pass-through deduction, or Section 199A, whatever you want to call it, that small business deduction is going to go away. And then estate and gift exemptions are going to reset back to their lower rates as well. So I want to shift gears a bit and focus more on the credits and incentive opportunities that you should be considering. So first up there, we have the employee retention credit, the ERC. This is a refundable payroll tax credit. There's different rules for 2020 and 2021, but basically for 2020, the max credit is $5,000 per employee. And then in 2021, it becomes $7,000 per employee per quarter. So, potentially $21,000 per employee. And that's assuming you qualify for all these quarters. So the right-hand side of that slide talks about what's an eligible employer, because again, you have to determine that you qualify before claiming this credit. So different rules again in 2020 and 2021. There's a revenue decline portion, revenue decline test, and you only have to meet one of these two tests. That's either 50% for any quarter compared to a quarter in 2019, if we're talking about 2020, and then that decline goes down to that test goes down to a 20% revenue decline in 2020-21. So it becomes much easier to meet that test, that revenue decline test in 2021. The other test that you can meet in either quarters, the full or partial suspension of operations. And this is going to be very dependent on those facts and circumstances. So Sam, if you want to move on to the next slide, this will kind of lead into that. The only thing I want to mention on here is that number one, determining and documenting eligibility, especially when it comes to a partial suspension of operations. There is a lot of, I guess what we'll call differing opinions on what qualifies as a partial suspension. And especially when we get into different areas like supply chain interruptions. And just so everyone's aware, the IRS actually issued a warning last month, basically to be wary of third parties who are advising businesses that they are eligible when they really do not qualify. And within that notice, the IRS reiterated that any penalties and interests are the responsibility of the business, not the firm they hired to claim that credit. So if you do claim this credit, just make sure you're reaching out your advisor before moving through with anything. And then just the last item before I move on to credits and incentives, the ERC, you're still available to claim. You're able to claim for still another year now for 2020, but the IRS is taking a long time to issue these refunds. In some circumstances, it's gone beyond a year. So if you haven't looked at it, just make sure you do sooner or later, because it's likely going to take a while to receive that refund. All right, so next slide. I'm going to skip down to the state and local incentives here. Governments and municipalities are offering, and will offer a variety of incentive programs to bring in economic growth into their areas or their jurisdictions. And they really don't advertise this. Now, you may hear some stories about, let's say, Amazon or Ford getting, $1 billion tax relief to basically build a facility in a certain jurisdiction. But these programs are available to companies of all sizes. Now, there is some thresholds for sure. And these types of incentives are being negotiated every day with these jurisdictions. So a couple examples on here: tax credits for creating jobs, tax credits for investments, property tax abatements. But the one thing I do want to mention is that the key is that these negotiations have to happen up front. So once you buy that piece of land, once you start construction on that facility, the state and the local agencies are much less likely to want to negotiate any incentives, since you've basically committed already and kind of lost all your leverage. So in terms of planning, just ask yourself, are you considering buying a new building, building a new building? Do you plan on adding any jobs, even if it's to an existing facility? And, are you looking to relocate? And if the answer is yes to any of those, you really should be reaching out to your advisor to kind of discuss these opportunities, because they're a great way to help finance, or at least partially finance, some of the growth for your business. Okay, last slide here before we turn it over to Gerald. So this is something a little bit different. It's kind of outside the realm of tax, but a really significant reporting requirement is on the horizon that is going to impact tens of millions of businesses. I think the Treasury estimates 30 million businesses will be impacted by this, at least in year one. And that's as a result of something called the Commercial Transparency Act, also referred to as the CETA. And this act was actually passed back in 2021. And what this law does, and what it's going to do, is require businesses to disclose their ultimate beneficial owners, meaning individuals, to the Financial Crimes Enforcement Network, or FinCEN. And it's going to be in the form of, at least initially, something called an initial report. And if you don't do this, there are some significant penalties. So I believe it's $500 per day that you're late and up to $10,000 in criminal penalties. So if you think about that $500 per day, these penalties can add up really quickly. There are certain exceptions. You see that large operating company exception. Now, their definition of large is not that large. It's 20 employees and $5 million of revenue. So just before we end here, I just want to talk about some key dates for this. So entities created prior to January 1st, 2024, so all entities right now, have to file an initial report by January 1st of 2025, unless they meet an exception. And then any new entities going forward will have to report within 30 days of receiving notification that they are effectively formed. So pretty significant change in terms of disclosures. I don't know if we've ever really had anything like this before, but we'll be following it closely as we move forward through the year and Treasury releases more details. All right, so Gerald, I'm going to turn it over to you for a little bit of information about some pending legislation related to retirement plans.
All right, thanks, Tony. And just jump in when you need to wrap things up. I want to just take a minute and kind of give everybody a little bit of an update on what we're calling Secure 2.0. Don't know if that's what the official title is going to be, but here's kind of where this all stands. So that both the House and the Senate have passed a couple bills each and kind of pulled them together in a joint reconciliation that we're labeling as Secure 2.0. And that's where it sits right now. In this joint reconciliation, we do not know what that looks like. So everybody's been kind of pretty tight-lipped because there is differences between the House version and the Senate version, and I may touch on a little bit of that in a second here. But right now, we're all kind of waiting. That budget reconciliation bill that Mike had alluded to might be what this gets tacked to. We'll see what happens. When Secure 1.0 passed in December of 2019, that's exactly what happened back then. So that's kind of where we're waiting. This would be a really huge piece of legislation for the retirement area. There's a lot of interesting things in here, a lot of goodies, a lot of voluntary things, a lot of mandatory things. It would have a pretty big impact on the retirement industry and give a lot of things for us to talk to our clients about. I just wanted to touch on a few highlights. One is the effective date. We might be looking at a lot of it being delayed to 24 because it's coming out so late in the year, but we'll see how that goes. We would be looking at auto enrollment being applied to any new plan. Congress really wants to see, and there's a lot of bipartisan support for this bill. Congress really wants to see retirement plan coverage expanded. So they've done a lot of really good things over the past few years to help that. In this bill, every new plan would have to have auto enrollment. That's a pretty positive thing when it comes to that. They're also talking about requiring existing plans to do auto re-enrollment every 3 years. So once again, sweeping everybody who isn't participating in a plan back into being automatically enrolled. An expansion of startup tax credits for retirement plans. That's a pretty neat thing. Just trying to make it easier for plans to get off the ground, cover their initial startup and operation costs for the first few years. That's a pretty positive thing. They're also looking at modifying the savers credit. So this really applies to lower paid people that are kind of starting off saving in retirement plans. Guys, make sure we are paying attention to this for our clients. And I'll give you a great example. My son, when he started up a job a few years back, his first year, he started later in the year. So based on what he made, he was eligible to take advantage of this saver credit. And, a lot of people look at this and go, oh, no, the person's going to be over the income limit. Maybe not in that first year. So we definitely need to be keeping our eyes peeled for that sort of thing. So they're looking at taking that savers credit and turning it into a refundable tax credit if it gets funded to a retirement account. That's pretty cool. But the logistics of that are going to be a little tricky. So there's a lot of those kinds of elements that we're going to need to see in the regs how that gets sorted out. They're looking at pushing the required minimum distribution RMD age ultimately out to age 75. That's going to kind of help the people that maybe don't need to be taking the RMDs versus the everyday person. So I'm not quite sure why they're excited about that one. Requiring catch-up contributions to only be funded to Roth. That one, people aren't really looking at that through the lens of that's cracking open a door that could be really interesting if it gets pulled open wider. We all know how Roth works from the standpoint you're not going to get a tax deduction for the dollars going in, but you won't pay tax when you pull it out. And the way budgets work in Washington, they have a 10-year window. So they love things that free up and create more revenue today, i.e., you don't get a deduction for something you used to get a deduction for. They get to count that as revenue when they're pricing out these bills. They don't worry about the fact that they're going to lose the tax revenue because it's outside the 10-year budget window. So you put something like this into retirement plan world, a mandatory kind of a thing, and all of a sudden that opens the door for, okay, down the road, are we going to see something like when you force auto enrollment on all these plans, all those people are going to be required to be enrolled Roth. And then it just keeps going to where someday all retirement plan contributions are just Roth. So I don't want to get too far ahead of myself pontificating, but it's just a little food for thought there. They're looking at making simples and SEPs have the ability to do them with Roth. So that's kind of interesting. They're looking at creating some more conformity behind the scenes when it comes to hardship rules between Roths and 403B plans. They kind of play with different sets of rules. We're looking at the savers, a savers match credit. The Senate bill actually had a very interesting provision that really would be out there to help lower income people. And it's going to be tricky to implement, but it's got some neat repercussions to it. So we'll kind of see how that all unfolds and if it ends up showing itself in the final bill. So those were the things I wanted to share. And Tony, I'll turn it back over to you.
All right, thanks a lot, Gerald. So a lot of stuff to consider from this presentation and really not just over the next month. I know we call this year-end planning, but you really need to think well beyond the year for really effective tax planning to take place. So we're just about out of time here. I know there's a couple of questions that came in. We will reach out to you for those. I just want to thank everyone again for joining us today. I hope that you were able to take away at least a few items from our speakers. Again, any other additional questions, feel free to reach out to us. Our contact information or our email, I believe, is at the top underneath our pictures there in the presentation or in the slides. Or if you have a Raymond advisor, of course, always feel free to reach out directly to them. So it's 12 o'clock now. So thanks again, everyone, and have a good rest of the day.